Stocks gained on Tuesday, with the S&P 500 and Dow Jones Industrials reaching 15-month highs. While the NASDAQ 100 is reaching an 18-month high. The earnings season is underway. There were strong second-quarter profits from Morgan Stanley, MS, and Bank of America, BAC. This spurred a rally in bank stocks and had the flow-on effect of lifting the broader market. Thus the S&P 500 index, SPY, rose plus 0.71%, and the NASDAQ 100 index, QQQ, closed up plus 0.82%. Bank stocks and their strong earnings, no surprises here. Not only did BAC and MS exceed analysts' expectations in the second quarter. Also JP Morgan, JPM, and Citigroup, C, outperformed. In fact, with the exception of Citigroup, bank earnings exceed the earnings posted a year ago. This should not be a surprise. But the constant talk of a pending recession dampened expectations. If it were not for the turmoil in bank stocks in March due to the collapse of two banks, the banks would be way ahead in terms of performance. Thus, bank stocks, in particular the major banks, are undervalued. BAC in particular trading below book value. There is a lot of catching up to do in the second half of 2023. So far the earning reports for the banks indicate that the loan balances at the major U.S. banks have continued to rise. This is despite a decline in loan applications nationwide since the first quarter. Behind the data could be a growing disparity in loan growth between the major banks and regional banks. The effects of higher interest rates are yet to fully feed through into the broad economy. This could set the stage for a sustained decline in loan applications for the rest of the year. At JPM, America's biggest bank by assets, average loans rose 13% in the fiscal second quarter. This included a 19% gain in the Consumer and Community Banking (CCB) division. On Tuesday, weaker than expected U.S. economic data on Tuesday pushed T-note yields lower. This helped stocks rally, boosting the broader stock market. Recent lower readings on inflation have lifted expectations that the Fed is nearing the end of its rate hike cycle. The expectation of the markets is at 95% for a plus 25 BP rate hike at the next FOMC meeting in July. Markets expect a peak funds rate of 5.40% by year-end. Currently the effective Fed funds rate is 5.08%. Enough on the Fed and talks of a recession. Stocks are not listening and have not been listing since January. June retail sales in the United States grew plus 0.2% MO.M. This missed forecasts of plus 0.5% MO.M. Manufacturing output in the United States declined minus 0.3% MO.M, falling short of forecasts for no change. The July NAHB housing market index in the United States increased plus 1 to a 13-month high of 56. This was in line with expectations. All the graphs in this video are by BARCHART. If you are thinking of subscribing to BARCHART, my affiliate link is in the comments. Also included are my affiliate links to the online brokers, eToro, First Trade, and FX Primus. These videos give a quick overview of the U.S. stock markets with a couple of stock ideas. Issued on Mondays, Wednesdays and Fridays based on the underlying blog. Visit my blog site www.smartestdata.blog. If you like these videos, hit like and subscribe, it really does help the channel. See you in the next video.